right, we got a lot of earnings stories and economic talk and stock market records to digest. And joining us here for the full hour on the open is longtime BNN Bloomberg guest Brianne Gardner. She's senior wealth manager at Velocity Investment Partners at Raymond James. Great to see you.
Yeah, thanks for having me.
Never a dull moment in these markets. I mean, what a week from meme stocks to new views on inflation or maybe old views on inflation. What's been standing out to you in the markets of late? I would add to that we're basically sitting at record highs for stocks.
Yeah, I think we saw obviously the inflation data that we got yesterday, both headline and core inflation coming down, which is, favorable. And I think that's why we saw this, short-term rally in the markets. And that's what we think is the biggest impact on market movements as of lately. So everyone is watching that very closely, including the Fed, right, who is saying their target for inflation is that 2%. Even if we remove, though, housing out of CPI, we are seeing it close to that 2%. So I do think that the Fed and Bank of Canada do have to be a little bit careful on the decisions that they make and not be too slow to make rate cuts. I do see September as a rate cut for the U.S. back on the table. I think that is what the markets are rallying as well on. And then Canada, we are seeing potentially Canada a little bit more of a weaker economic standpoint than the U.S., so potentially cuts ahead of America. I think markets hitting a new high is obviously positive for momentum, and sometimes it's important not to or to continue to ride that momentum in the markets. And we've seen on average, the average bull market that we're experiencing, or the median bull market, is around 511 days. We're about 580 days in this bull market. And the average, though, is around 1,000. So there's potential still legs of this market. Not to say volatility isn't warranted after just coming off the back of a 5.5% correction. Yeah. But there's still definitely upside.
Well, and even we're showing the TSX chart there, and we showed the S&P 500 chart. It's not as if we saw a huge sell-off in U.S. equities, broadly speaking, before investors jump back in. And that momentum story is an important one. It's an important one, too. I know the market is trying to think forward about where we're going. But at the end of the day, we still have not seen an official pivot to rate cuts, right, by the U.S. Fed or the Bank of Canada. Coming into this year, a lot of the pundits were talking about in the United States, 6, 7 rate cuts? That was what we needed to see this year. We've dialed back those expectations, but investors have kept putting money into the stock market. So maybe holding the hand of the Fed is something that we don't need to do as much as before, assuming, and I guess it's the big if the profit picture looks good enough, if the economic picture looks good enough not to go into meltdown mode and higher interest rates. Maybe that's the lingering uncertainty out there.
Yeah, I definitely agree, John. I think that, what can continue to push this bull market higher is, profitability, earnings. We've seen 90% of earnings report. We're seeing strong market breadth in the market as well. 60% of companies are above their 50-day. 80% of companies are above their 200-day moving average. That is showing us, investors are going from, shifting from that more feared to, becoming more bullish and comfortable putting money into the market, which is favorable for stocks. Looking back at earnings, Q1 is expected to be about 7% just over growth. Q2, we're expected to see over 10% earnings growth. So all of these things are positive. We are seeing, yes, some cracks in the economy, like retail sales starting to slow, which, is a sign of potentially slowing growth. And if we're seeing retail sales slow, consumers are going to be tightening the belt on spending, and that means ultimately GDP slowing. So our expectations are we still see a recession, but a mild recession. Right now, the U.S. is projecting Q2 and Q3 to be negative. So 2 negative quarters would confirm a recession out of the U.S., and then we think things are going to go higher. I mean, there's still a lot of bullish things, right? We're in the U.S. election year, which historically is strong for markets. And again, a lot of companies are beating on earnings.
I think the other complicating factor, it feels like, you just talked about some of the cautiousness on the retail front, and we definitely saw that this week in the U.S. after talking about it for months here in Canada. But then we've got these 2 retail stories today. We've got Walmart, which says, by the way, we're also catering to a higher net worth individual. Investors like what they hear. They're bidding up Walmart shares. We talked about Canada Goose, which I would think that the price of all of their parkas and gear would leave some feeling a little bit cautious. They put together a good quarter. We're reminded they've got a big business in China where there's been a recovery story as well. So your head can spin as an investor when we're talking about cautious spending, and then Canada Goose and Walmart are the two top stock stories of the day.
Yeah, I think we saw, Walmart, I think, staple company that has done very well. And historically, it does tailor to, both a lower income and higher income now. And they have done a great job at pivoting that model. They've also cut their healthcare division in Walmart, which we think, will help boost profitability for the stock. The stock's up about, I think 14% year to date. And as you mentioned earlier, their online sales, their e-commerce growth, we saw over
huge.
20% in the US. So that's great. I think their CFO said too, their grocery business, with the costs of eating out at restaurants being so high due to inflation, a lot more people are cooking at home and making meals at home, which has boosted also their grocery. So we continue to see that trend for Walmart. For Canada Goose, the stock has kind of been on a downward trend for some while. So a little pop isn't bad, but we also saw, they cut their workforce, slashed their workforce a bit ago. I think they cut 17% of their jobs. So, it's nice to see a little bit of recovery, not really a stock we own. I think a little bit more higher risk.